Hello everyone. So welcome to another new playlist on the topic of cash reconciliation. So this concept of cash reconciliation is usually discussed in the management or financial accounting subject where you are talking about internal control of the cash. Okay, so to understand this concept of cash reconciliation, so this diagram which I have taken from the textbook will be very useful. Okay, so again, if you are joining this playlist, please go through. This is the first video in the playlist. This is the introduction, and I have taken this financial accounting 7th edition from Kimmel, Weigand and Kiso, this book. And in this book there is this particular chapter on cash, and this particular diagram is there in that particular book. And I have reproduced, basically xeroxed and pasted in my book to explain this concept of what is called as a cash reconciliation. Okay, so what is this cash reconciliation? Now, if you look at the cash balance, so you're having an account book of your company. So the right side is the company, left side is the bank. So if you see your in the financial statement of the company, there is something called cash. Okay, so for example, if I go back, I can show you some sample uh, balance sheet of a company. So just let me check. We have done so many uh, balance sheets. So for example, here if you see classified balance sheet. Okay, so here you have cash of 18,270. So the question is, where is this cash located? So this cash is listed under the assets of the company, Finzenberg Consultants. But this cash is actually, even though listed under the assets of the company, this cash is actually what is deposited at the bank. Okay, so when you compare the bank statement and your account statement, both should have the same amount because this amount is actually present in the bank. So you see, left side you have bank statement, right side you have your account books, but both of them cash balance should be exactly equal. What happens if they are not equal? So if it is not equal, then you have to do cash reconciliation and then you have to do these steps. Okay, so this diagram is very important. So let's try to understand. Okay, so first one is called deposit in transit. What is deposit in transit is, for example, the company deposited some money in the bank, but that money which is being deposited, that still it is under processing. Okay, so maybe I have sent somebody to deposit in the bank or whatever. So that's still under processing. So as per the account books of the company, the money has been deposited in the bank, but still the bank has not yet received that particular money. So as per the bank statement, still that money is not yet deposited. So that is called deposit in transit. So in this case, what is the correction? See, bank is not aware because you know that somebody went to the bank. Actually, they should draw the van in the opposite direction. But anyway, so somebody from the company went to the bank to deposit the money, but still that bank does not know that somebody is coming. So in the bank statement, you will not have that amount. Okay, so this adjustment has to be made in the bank statement, assuming that, see, because as per your accounts already you have deposited money in the bank, so this deposits in transit should be added to your bank statement. Okay, so here I will just mention that. So we have to add that amount. Okay, because bank is not aware of this. Okay, similarly, now let's come for this outstanding check. What is outstanding check? According to your company, you have to make a payment to some third party. So the company gives a check to the third party. Now the third party will submit the check to the bank. Only then the bank will be knowing about this outstanding check. Otherwise, bank will not be knowing about the outstanding check. Therefore, in the bank statement, the outstanding checks will be absent. Therefore, we need to add the outstanding checks. Add in the sense we need to include the outstanding check, but in this case, it will be less. You will be subtracting the whatever outstanding checks are there. Okay, so let me explain. So maybe I will make a drawing here. So let's say this is company. So and this is bank. So company is sending deposit. So this deposit has left the company, but then still it is still not yet reached the bank, or still maybe the bank is not yet processed the application, or maybe the bank has just received the application and still it is under processing. Okay, so this is called deposit in transit. So here what you have to do, the company will already record that, because company is making the deposit to the bank. So in the company's cash account, that amount is already deposited. That means added. Whereas in the bank, that amount is not yet added. Therefore, here we are saying add the deposit in transit. Next step is subtract the outstanding check. Okay, what is this outstanding check? See, there is a third party. Okay, so some supplier or client or somebody, third party, and the company has to make a payment. Okay, so maybe electricity bill or utilities bill or whatever. So the company makes a payment in form of a check. So the company submitted the check to the supplier, and after a few days, so maybe this was submitted on 7th of August, and maybe on 11th of August or 18th of August or whatever, the supplier will deposit the check. So in between, during this time, it is called outstanding check. Okay, so outstanding check. Now outstanding check amount already adjusted in the cash, because the company knows that it has given a check. Therefore, in the company cash account, they will reduce the amount. But still, in the bank they don't reduce. See, whenever the third party deposits the check, what they will do, the bank will remove the money from the company's account and add it to the supplier's account. Okay, that is what the outstanding depositing of check will happen. Okay, so that is about this one. So that's why we have to reduce from the bank statement. So remember, original bank statement, whatever balance, you have to add the deposits in transit, and we have to subtract the outstanding checks. Then finally, there could be bank errors. Okay, so this could be plus or minus. Okay, so add or less. See, sometimes the bank may make a positive error or negative error. That means, let's say you deposit $1,000 in the bank. By mistake, bank only types 100, that is only 100. So $900 is deposited less into the bank, but according to your cash balance, it will be more. So adjustment needs to be made at the bank side. So any errors are there like this. Okay, these are the adjustments on the bank side. What are the adjustments on the company's side? Okay, so the first one is notes collected by bank. Okay, so meanwhile, see, let's say somebody wants to like there is a customer. Okay, so again let me draw one more diagram. So this is a company, and this is a customer. So customer purchases some amount, purchases some product from the company. So therefore, the product from the company or service from the company is given to the customer. In return, customer has taken, it's something like a accounts receivable from the company. So customer has taken the product on account. Okay. So later the customer says, okay, I will pay you after 1 week, or I will pay you after 1 month, or whatever. Now customer does not directly give money to the company. Meanwhile, customer simply pays notes. Okay, so notes payable directly goes to the bank. So now on what date this note payable received by the bank, the company is not aware. So what the bank will do, bank will receive the money from the customer, and then it will add to the bank account, and then it will send the information. Okay, so notes payable information, or payable message, or information, or whatever. So, or a memo. Okay, so it's called memo. Okay, so the memo is given to the company. Looking at the memo, the company will have to increase the cash, because here the bank has received the payment, but company has not yet received the payment. So therefore, these notes collected by bank, that is something that needs to be added to the bank account. Okay, so that is about this note. So here I will say add. Next, bounced check. What does this mean is, again look at the situation. So this is a check submitted by the let me draw one more diagram here. Okay, so let me say again, this is the company, So we are the company. Now this is your customer, and this is the bank. Now customer takes a product. So customer takes a product and gives a check. So you received the check. Now that check is deposited in the bank. Okay, so deposit. So now when the bank receives the check from the company, according to company, the cash will increase. Okay, so the cash account will increase because company thinks that, okay, I received the money, so I received the check, so cash will increase. But when at the time of depositing in the bank realizes that this customer has NSF, no sufficient fund. So in the customer's bank account, sufficient fund is not available. So at that time, what happens to this check? The check will bounce. Okay, so when the check bounces, what is the adjustment you have to do? So company has not to do anything, but the cash has to reduce because you have to reverse the transaction because the check has bounced. Okay, so the company has to reduce. So that information that the check has bounced, the bank will tell to the company. Therefore, company will have to adjust that in the listing. So here, not sufficient fund, NSF, has to be less. Okay, so here we have to less. So this is the structure actually. Look at the left side, bank. First you take the opening balance, then you add the deposit in transit, then you less the outstanding check, and then you add or less the errors. Similarly, on the customers, on the company side, you take the opening balance of the company, then you add the notes collected by bank, then add the or subtract the NSF checks. Next, printing or other services. So a lot of times this bank will have some services. Okay, so that I can just draw like this, bank services. So what are these bank services? Printing of checkbook or some kind of renewal fee or some kind of payment, whatever. So for processing charges, whatever. So bank will give some bank services expenses. So that has to be. So bank, what it will do? It will not send any bill to the company. Bank will simply deduct the amount from the balance of this company. Therefore, but it will send a memo. Okay, so according to that, the company has to reduce the cash account. Okay, so that is why this one. So here the printing charges or whatever, this has to be reduced on the company's side. Okay. And finally, company themselves make an error. Okay, what is this meaning? Company making an error. Let's say company sold an item and the selling price was $1,000, but company while entering it into the their journal, they have entered it as 1200. Okay? Instead of 1000, they have entered it as 1200 as their revenue. So the revenue will be 1200, cash will also be shown more 200. So that needs to be adjusted. Okay, so here we have to do add or less your adjustment, whatever company. See, who makes the mistake, they have to do the correction. If the bank is making a mistake, bank has to do the correction. If the company is making a mistake, company has to do the correction. So this whole concept is called cash reconciliation. And once these left side steps are completed and once right side steps are completed, then finally the correct cash balance both should match. Cash balance in the bank should match the cash balance of the company. So this is the whole reconciliation process. Okay, so this is the basic introduction video on this concept of cash reconciliation. So we will look at one example problem to understand how this cash reconciliation is done. Okay, so this is just the introduction video. We are not solving any problem here, but in the next video we will be based on this diagram. In fact, all this playlist will be based on this diagram. This diagram is important. So let us come back to this. So see you in the next video where we will solve one example problem on this concept. Thank you. If you like this video, please press the like button and subscribe to my channel and refer this channel to your friends so that they can be benefited. Thank you. See you in the next video.